I was looking at the debt load and I got a little depressed. I said, the only way out is a currency debasement or a default. I had this visual. I still remember the visual of, oh, there's always a place to go. And the place to go is to step onto Bitcoin. Bitcoin will slowly be, people say life wrapped. I just say terra firma. Like, it's not just an asset like gold, it's actually an observable network of strength and intensity that you can step onto that will hold value while we rebuild. So then I just dug like a mofo. I dug like a gopher and just kept going and saying, well, how am I wrong? How am I wrong? And I'm still looking for how I'm wrong, Tyler.
Hey everybody, Tyler here, and today I'm joined by Mark Connors, founder of Risk Dimensions and former global head of portfolio and risk at Credit Suisse. Mark brings 4 decades of experience across hedge funds, global banks, and institutional advisory. And today, through Risk Dimensions, Mark's focus is helping TradFi allocators in the corporate universe think through a Bitcoin allocation. Mark, welcome to the show.
Thanks a lot, Tyler. You did a good job there with the background. I do want caveats. I do say 40 years because even though when I started as an intern on Solomon's desk in 86, it was a very impactful period because I got to meet the piranha from the book Liar's Poker. It was written that summer that I was there. Tom
Oh,
Bernard
no
was
way.
piranha. Michael Lewis he was rotating through, he was behind me. And I didn't know it till later that it was him. So it wasn't a full-time job, but since it was at Solomon at that period, I do include it as the starting point because of its storied and unique place in history.
That's really cool. How did you end up at Salomon, Mark?
It's all talk about, time and place. Bill Boutte was one of the 3, they called him the triumvirate. Strauss, Goodfriend, and Boutte ran Solomon. And they were a little partnership, a sleepy bond house. And bonds were like the ass end of finance for the most of the 70s because rates were just skyrocketing and bond prices were dropping. So Salomon Brothers was bought by a firm called Fibro, a commodities firm. You guys remember Trading Places, the Eddie Murphy movie?
Yeah.
That was written in 83 when commodities had already peaked in 81. So commodities were king. Oil was up, gold was up. It was great to be. And Fibro was a commodities firm. They bought the sleepy bond firm Salomon. They bought it, Tyler, in September of 81. Fibro said, you know what? We should probably have exposure to rates in case things change. That was the exact week that Volcker stopped hiking rates. And rates went from 16% to 10-year to effectively zero in 2020. So it was quite a bond run. And Bill Boutte was in our town, to answer your question. His daughter Carolyn was in my class. We didn't know who he was, what he did, but my dad's like, call Bill Boutte, try to get a job. So I called him up. He said, fine. I ended up sitting right between the 2 Vinnies who were in the corporate bond desk, Jeff Coley, and there was a 4th seat open. And I watched and learned about bonds, read the complete bond book by Dars, stayed late, learned a lot. It was pretty cool experience.
That's really cool. And yeah, to be on the ground floor of like, that secular, 35-year bond market must have been pretty cool to see. Obviously now we're in a little bit of a different regime. And before we
Different regime, my friend.
talk about Bitcoin markets and Bitcoin treasuries and whatnot, I think we should talk a little bit macro and, what's happening with the bond markets today. We're recording this as Kevin Warsh is probably going to go up to a vote next week on the Federal Reserve. We may know by the time this episode drops that he's been confirmed as the
Yep.
next head of the Fed. What's your take on Warsh coming in and he's got a really tall task ahead of him, doesn't he?
Yeah. So I have a Substack, the macro case for Bitcoin, and we try to make it interesting instead of just doing the doom loop about how much debt we have, Tyler, because you want to put your head in an oven after you read that too much. So the Who. I love the Who. They wrote a song called Won't Get Fooled Again. They wrote it the day before Nixon, or they released it the day before Nixon broke the peg to gold on August 15th of 19, that Saturday before Nixon. So, it's like the old boss, just like the new boss. So it's all there for us, Tyler, hiding in plain sight. All the music from the 70s tells us what's happening right now because
Hmm.
they also went through a huge regime shift.
Yeah,
So to
yeah.
answer your question, the Economist had, Kevin Warsh, how will he fix the Fed? And I responded back in a little tweet, he won't. It's he won't. It'll continue to foster debt. And so this is my big take and hold my feet to the fire. In the next 6 months, maybe earlier, the supplemental leverage ratio among the member banks of the Fed will be fully repealed and lifted. It's in process. So the banks can own treasuries at effectively no cost. And therefore, the Fed does not have to buy them. They'll look at their balance sheet and say, hey, my balance sheet's fine. But Citi, JP, Wells, their balance sheet from a growth standpoint will go a lot higher because they will buy bills. Seem to be no risk. And then whether they have to share the interest with the Fed, I don't know how that's going to be done. But this is all going to be just a shifting risk. Put the balls from the Treasury that have to be rolled over, put them through the Fed into the banks. You can see those balance sheets go up. So will he change anything? Absolutely not, because we need to keep issuing debt to keep things going.
Yeah. It's interesting thinking about like trying to square some of Kevin Warsh's previous comments. And I know when people actually get into the Fed, he's been on the board of governors before, but when they get in, they act a lot differently than a lot of their public comments. So I expect the same, like you said, kind of the same thing. Markets are worried that he's had a hawkish tone and that he wants to taper more aggressively the balance sheet. Um, yeah, I mean, can he? I guess if the SLR is repealed, and just to go a little high level for our audience here, Mark, that would allow, like you said, banks to just basically lever to add more treasuries
Yeah,
to
so
their
let's
balance
let's
sheet.
uh, touch on that. So banks have assets and liabilities. They take your money as a deposit, and they lend it out in the form of I borrow a mortgage, so I take your deposit money. They give it to me. They take a vig, etc. They can also take your deposit and buy a treasury. Well, what happens if they can buy a treasury and effectively put no margin down on that treasury? How does that look? So that is something where it's zero risk, they can just own it and it's seen as an asset without any risk associated to it. Says the SLR, Tyler, was put in place to say even if it's no risk, regardless, and it's a great measure. As a former chief risk officer at a hedge fund, a multi-strat, if you don't have these counter cyclical hard limits, you're going to find yourself in one cycle to be way off sides. So it's useful. And when it goes away, it's an indication that sanity has left the room, and put your head between your legs and kiss your ass goodbye because it's crashing.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
It's the best kept secret known by every true Bitcoin OG. CoinKite has been building the gold standard in private key security for years, and they just raised the bar again. The Cold Card Q is an absolute powerhouse for serious Bitcoin treasuries. We're talking a full QWERTY keyboard, air gap protections, and it's built for maximum security. The brand new Cold Card MK5, it has a massive Gorilla Glass screen and new NFC functionality for an even more seamless experience. So if your business is large or small, there's a cold card for you. Head to store.coinkite.com and use the code 6BT at checkout for 6% off. Stop cutting corners on your Bitcoin treasury. You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull the collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
Yeah, I mean, obviously the foreign demand famously has started to dry up. We have seen hedge funds, lever up a little bit more on treasuries. How long is the runway for this type of thing, Mark? None of us has a crystal ball, but
And so I said that, and I felt victim to the hyperbolic thing by, put your head between your legs and kiss your butt goodbye. That's not the case, because actually it's just going to be inflation. When you said the hedge funds are stepping in, they are, but they're also the player, Tyler, in March 12th of 2020, when the shit really hit the fan in COVID, and we started realizing the Diamond Princess is not going to make landfall before 80,000 people die in that packed boat, whatever it was, 8,000. Hedge funds will sell at the wrong time as it relates to the US government. They're going to sell into stress. And that's what happened. And that's why the Fed stepped in and had like 4 emergency meetings in a matter of 10 days. So hedge funds are a big buyer, and they're necessary. They're a disintermediary. They will play the cash treasuries against futures, and they are one of the largest holders. The Fed doesn't like it, but they need it. So it's like, all right, well, you're going to kick hedge funds out, good luck. But as they grow, they aren't the holder you want in times of stress. When margin goes away and risk gets decreased, what happens is the reason they're in the trade starts to invert. What they're long goes down in price, and what they're short goes up in price. A classic crowded trade unwind like we had in COVID. So you bringing it up is a great point. Is look what we're doing. Foreign demand down. Hedge funds are stepping in because it's now become more attractive because there's less buyers, but they'll leave at the wrong time as it relates to a US government trying to have regular auctions that don't fail.
yeah, yeah, and of course, Bessent at Treasury and Warsh certainly have that perspective. And one of the key points that at least Bessent's been talking about over since he's come into his position at the Treasury is being able to term out some of this debt. What ways do you think the Fed can,
Hold
make
on,
that happen
hold
for
on.
the
Did
Treasury?
did he say he wants to term it out, Tyler?
I guess he criticized Yellen for financing the short end more, right?
Yes, right.
Uh-huh.
And then E2 Brute, right?
Yeah, yeah.
And then look at him. He's like, you know what? This front end tastes really good. I like this front end. And now, as you said, they say a lot of things before they step in, and when they get in there, they're like, oh my God, this is an intractable situation. Look at Doge,
Yeah.
smartest guy on the planet. Hard to say he's not. He's like, this is, I'm out.
Mm, mm.
I
Yeah.
can't fix it. I can't fix the spend. So Elon leaves. Bessent comes in. I hate the front end. And what does he do? We're up to 25, 27% from 18%. T-bill funded liabilities
Yeah, and growing, right?
and growing, my friend. Tick tock.
Yeah, yeah.
Yep.
Yeah, it definitely seems we're kind of beyond the event horizon. The only question is, how much runway does this train have? And Bitcoin's always kind of I feel like a bit of a forward indicator, not to read too much into the day-to-day
Well,
price, but with
I'm reading the clock behind your head, and
Yeah.
it says 80,430. I'm digging what that direction says.
Right, right. Yeah, I think it's pretty indicative. Are there any levers at all that Congress have, that the Treasury have, um, you know, left to pull since the great financial crisis? I think that was like a big turning point, right? Is that um, the massive bailouts to industry from the Fed and the Treasury, through a lot of legislation that was passed through the Obama's first term, and basically since then they haven't allowed any recessions to happen. So are there any levers to pull, or is this the swan song completely, Mark?
There aren't levers to pull, and we're already seeing at the state level what happens when you uh, do make non-economic, non-market decisions like taxes. Hochul 4 years ago, the current governor of New York said, if you don't want to live here, forget it. This is how we do it. And now she's courting the billionaires, saying, we need you. It's your duty. And it's like, I don't know who gave her that script, man, but it was. And then you have, obviously, the mayor of New York standing in front of Ken Griffin's place as, a tax the rich. Look at these people have. They're playing to a short-term game. We call that long time preference, which is counterintuitive. But your question was, are there any levers? And the answer is no. The only one that's there, and it's a long-term one, is means-based testing for Social Security, Medicare, everything. And that'll be ugly, but that's the only way to reduce the glide path. But that's like throwing a deck chair off the QE2, Tyler. Like,
Right.
holy God, I don't know what that does.
It's funny, Mark, when you say that as possible here. So like those are things I'll bring up, family outings when we talk economics or politics or something.
I'd
and
love to come to your
all
family
my,
outings, Tyler.
I was gonna say all my baby boomer generation family are look at me like I've got two heads, and they're like, you're crazy, because there's no political will for that, certainly.
There's
But
no
eventually,
will for that, but the numbers can bear it out. Like, how does a socialist become mayor of New York? Because
Yeah.
of numbers.
Yeah.
Because there's a big disenfranchised, disaffected group that said, I don't know what it is, but sure is a hell lot better than what I've had. So
Yeah.
means testing, I think, will pass.
Yeah. Yeah.
Just by the numbers. It'll pass as soon as the numbers work, and it will pass. 5, 10, I don't know what the number is.
Yep. And that's a step, but like you said, kind of throwing deck chairs off the Titanic. As you look back through economic history, like I mentioned, there was the great financial crisis you touched on, coming off the hard money standard under Nixon. Of course, the inception of the Federal Reserve in 1913. Is there one moment that's been a catalyst for this, Mark, that's led us off this kind of fiscal cliff, or has it just been like the slow like structured decline of big government, I guess?
I think when you want to look at those moments, Glass-Steagall, I think, was a 20-page document. Sorry, the repeal of Glass-Steagall under Clinton was a 20-page document. And that was the start of the end. The rationale was the bank said, hey, look at the Europeans. They really can go after it. I mean, going into 2008, Tyler, we had friends work at Deutsche Bank, and they were like a machine. Like, how can you do that kind of business? Like, they would fund, they led with credit. I mean, when you lead with lending, you get the higher margin equity business. JP Morgan knows that now. So Deutsche Bank's balance sheet, I think, was as large or 80 and somewhere between 80 to 120% the size of the GDP of Germany. So to put that in perspective, that would be like JP Morgan, whose balance sheet I believe is, I know it's below 5, but I think it's around 3 trillion, say. I'm going to guess around 3 trillion. So it's say 10%. It has been about 8 to 12% of GDP. It would be like JP Morgan's balance sheet being, $28 trillion. That's how big. No one knew what was going on there. So their Deutsche Bank's insignia was the square with a little like controlled growth. They were going crazy. And the US banks said, we want that. We can't compete unless we're going to be like them. So whenever someone says, like your kid, hey, you know what? Little Sally and Billy can do that. Why can't I do that? As a parent, you're like, yeah, for good reason. I don't want you to grow up to be a moron or to collapse. And we didn't do that. As a governing structure, we said, you want to be like them to compete globally? Great. Commercial banks, broker dealers, it's all mix and match, cats and dogs living together. Who cares about balance sheet and what could happen? Will the government be at risk? I don't think so. Oh, we were. So that was it. I think it was in the late, I forget the exact year, 98, 99, 97, when that was repealed. Very short document. And that was really it, because the financial system then became structurally open to all manner of infection. And that downstream effect we're seeing with Mandami and debt loads, everything.
Yeah, it makes sense when you frame it that way. It's funny. In Bitcoin, we've been critical of the SEC and how they kind of regulated by enforcement, and you've kind of seen the same thing, like you said, since the repeal of Glass-Steagall with the Federal Reserve System and the banks is regulations, uh, just like letting the banks kind of add, the investment banks and the commercial banks together, and then running into a problem and saying, hey, we're going to paper over it with a short-term fix, with a short-term regulation. So that doesn't happen again. They don't have the foresight to see. I don't think the regulators are versed enough in markets to be able to regulate in that way. So,
Or are they incentivized, Tyler? Like well, let's stick with your point. Can they see it? I think I'll bring something front and center instead of talking history. People say Powell will go down as not as bad as, Trump makes him to be and all that great, probably. But the one indefensible, and I will put my right pinky, I don't bet more than that, that the March 23 bank failures will be in, if graduate schools exist anymore after the onslaught of AI, it'll be in case studies. How could the Federal Reserve Chairman not put a 25 times increase, 25x increase in interest rates, and the asset prices on member banks and the harm it would do to asset coverage together before they decided that 9-month jihad on rates? It he sank the banks. It's fine, but to say that you didn't know that was going to happen is either stupid or naive. So when you talk about regulators, do they know that decision by Powell and then the, oh my God, what do we do now? That should be the big holy cow moment for everybody. How could the head of the banking system not have seen a 70% decline in 25% of the asset value of these major banks when they shot holes in 10 years and 30 years by having them go from, 50 basis points to 500 basis points? That is crazy.
Yeah, how do you if you're someone who's running a portfolio at a bank, how do you manage risk? You've got a background in risk, Mark, because SVB Bank, they mismanaged things, but they also had no idea that Powell's Fed would do what it did, and like you said, increase the rates so quickly.
I was in risk. I was a chief risk officer at hedge funds. When I went to Credit Suisse, I went to a role where I was outward facing. I did not want to be in charge of risk anymore because most, not all, most major institutions hire the risk person last. They don't empower them. And there's a 225-page report from Credit Suisse by Paul Weiss that goes through how Credit Suisse handled that Archegos moment and how it was flagged by some of the team, which I was, again, not part of. I was in strategy. I was the client-facing part of all the data at the firm. It was a great role. I loved it, but I also had to look sort of parallel and close to the fallout of what happens when people choose small amounts of revenue over huge amounts of potential risk. So the pay me now versus pay me later is front and center. SVB or First Republic, Tyler, I don't know which one, hadn't hired the risk person or brought someone in who was a clerk and totally unqualified. It was one of those two banks.
Oh man.
So when you said, how do they not know the risk? They weren't effing even pricing it in, Tyler. It is poorly. It is not. Business is so difficult now that anyone who says, let's price it, everyone says, well, how are we going to make our quarter if we start pricing risk? Now, some people will respond to this podcast and say, we do a good job. I'm sure there are some people that do. There are a lot that don't. And there's just a rogues gallery of people who don't, and we still are running through them, Tyler. We still have unpriced risk in the marketplace. And that's why Kevin Warsh, sure as shit fire is not going to be dumping treasuries and having price risk again attend these banks because he can't afford it.
Right, especially if the SLR is obliterated, right? It's just going to magnify any of the interest rate risk. So, let's step back and take a look at Bitcoin. What I guess I'd like to dig in first at what how was Bitcoin unlocked for you coming from a more traditional finance background, Mark?
So again, at my role at Credit Suisse, I was head of a division within Prime Services that looked at all the data across hedge funds. And what I would do is I would take that sentiment data, the positioning of all the hedge funds, aggregate it, anonymize it, and I would share it back and engage a lot of the heads of risk, some of the PMs at these hedge funds on what some of that tilt in oil or in tech versus industrials, what that meant. So we would, again, share it back. I then added, because my background, a layer of macro to it. So I had that meta approach of what's going on in the markets versus positioning, and I would write about that with my colleague Daniel McCoy about what that meant for the longer term thesis that people have about the secular trend in tech. Is it reversing? Is it a buy the dip or is it a get out of the trade? When I was writing one day, I was doing the macro side of it and looking at the debt load, and I got a little depressed. I'm like, oh my God, like I don't think we're turning back from, as you said, '08 was a big deal, 80% to 105% debt to GDP. That was '08. And then COVID, I call the COVID kick, knocked us to 120. Now we're 126. So when that happened, I said the only way out is a currency debasement or a default, which hurts wage earners and some asset owners. So I started to get depressed, but I had this visual clear. I still remember the visual of how there's always a place to go. Like the window opens when the door, and the place to go is to step onto Bitcoin. Bitcoin will slowly be, people say life wrapped. I just say terra firma. It is that, and all the more important now to use that term or appropriate, given the growing network. Like it's not just an asset like gold, it's actually an observable, with your clock behind you, an observable network of strength and tensity that, in true sense of the word, that you can step onto that will hold value while we rebuild. So that, to me, I was looking at the problems, how I'm wired, and I used to try to find, the next option. And that's when I said it. So then I just dug like a mofo. I dug like a gopher and just kept going and saying, well, how am I wrong? How am I wrong? And I'm still looking for how I'm wrong, Tyler. So that's the good news.
If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. CoinKite has been building the gold standard in Bitcoin private key security for years, and they just raised the bar again. The brand new Cold Card MK5 brings a massive Gorilla Glass screen and new NFC functionality for a more seamless experience. The Cold Card Q is an absolute powerhouse for serious Bitcoiners, with a full QWERTY keyboard, air-gapped, and built for maximum security. Whatever your setup, executive, Bitcoiner, Bitcoin treasury, there's a cold card for you. Head to store.coinkite.com and use code 6BT at checkout for 6% off.
The dip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry-leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody. There's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market-leading rates at every size. You can learn more at archlending.com.
Yeah, this last cycle of Bitcoin has certainly been, you know, the big
Disappointing.
one.
Freaking disappointing, Tyler.
It's been disappointing for sure, but it's been a bit. It's been one where the institutional focus has, started to arrive. I don't think it's fully arrived yet, certainly, and I
No,
think that
true, true,
think we've got a
true.
long way to run on that. But seeing some structural changes, now that the Bitcoin ETFs went live, back in 2024, we see there's been some corporate adoption with Michael Saylor certainly leading the charge, and revolutionizing with some digital credit offerings that he's had.
Crazy.
Yeah, how do you like? What's the next step in this?
So let's just look at you. I'm looking at your name and I'm looking at what you do. Your Bitcoin treasuries. You guys have done it by bubbling up and making easy access to data, which is important, right? You can't measure something that you don't identify. So you've made it easily available. I'm doing the same thing. And as far as how early are we? When I joined this firm 3IQ back in 22, out of Credit Suisse, it's a ETF provider in Canada. And I was head of research. It was a good way for me to shift gears to actually write about something that I was still learning about. The TradFi approach, to digital, just trying to stay authentic and bring that larger audience in. I came across, using my chief risk officer and my risk management, I looked at Bitcoin as part of that 60/40 offset about how it works. And I looked at it, I'm like, holy God, it actually increases even in horrible times like 2017 and 2022. In that 5-year period, Bitcoin went up 16.7% total. That compounds as a single digit midget. It's awful. But if you rotate it every quarter, about 3% Bitcoin, your return went up, I think, like 35%. 35% higher return in a 60/40, taking back a little bond and equity. And your downside deviation, which is a real, went down.
Yeah,
You reduce risk.
crazy.
So I talked to this person who was pretty well versed in the space. I'm like, does anyone else notice? And the person goes, yeah, you know what? Everyone knows about the 60/40. No one cares. That was in 2022. It's still the case, Tyler. I've created this portfolio optimizer and I show it about all different allocations. Everyone's like, I can't believe it. I'm like, yeah. And no one cares yet. It just takes time for the seed to set. BlackRock saw it. I forgot the name of the guy who orange pilled Larry Fink. It'll come to me. The guy who runs a digital asset group. He knew it. He saw it. And he had conviction as a subject matter expert about how powerful Bitcoin is and how invariant how variable it is relative to the other assets. It's got positive skew, Tyler. It's why companies do need to have Bitcoin on their balance sheet, but not for a quarterly, quarter-over-quarter asset liability match. It's a 3 to 5 year asset liability management system, no doubt. And any treasurer who looks at their cost structure and tries to even put inflation against it, but just versus having T-bills or another money market instrument, when they do the work, they'll also orange pill themselves. Robbie Mitchnick, that's the guy at BlackRock.
Okay.
So he orange pilled himself, and then he had the conviction and the data to stand in front of Larry Fink, who probably threw him out of his office 10 times before he finally got the ability to stay for the 12 minutes it took to convince him.
Yeah, it's crazy. I think we're still underselling the idea that BlackRock and Fidelity and, now Morgan Stanley have Bitcoin ETFs because, I think of Morgan Stanley, like their clients are just going to continue to allocate to that thing. And yeah, the sky's the limit as far as adoption goes. You still talk to people and, 99% of people you talk to can't tell you hardly anything about Bitcoin, right?
Nothing.
So-
And just to give some shout out to Chris Kuiper at Fidelity. He and his team have done a lot of work. He runs a digital asset research team at Fidelity. Good man, done the work. So it's all there. It's a hiding in plain sight meme. It's just with a miner who's ticking, about to give up before they break through the wall, to the big pile of gold. So you're right. It's been an awful year price-wise. So I didn't finish my sentence because I didn't think it through until you said it. It's been an undeniably constructive year with people like Morgan Stanley doing a full about face, Charles Schwab, full about face.
Going to be really exciting to see as things move forward. What's your take on what Saylor's been doing with strategy? And obviously he's going around saying he's had his iPhone moment with the STRC, the digital credit offering that pays the monthly dividends, soon to be twice a month dividends. And he's kind of arbitraging that expected performance of Bitcoin versus people seeking fixed income.
Yep.
That it's mainly retail right now, family offices, retail investors. But I imagine something like that's got to be pretty tempting for institutions to jump on eventually, or maybe banks are going to offer their own flavor of digital credit. What's your take on that, Mark?
I have an opinion, and it's strong, and it is two-headed. Preferreds are like the ass end of the capital structure. They are just not the priority that a bond is, and they don't have the upside of equity. And they are usually sold to retail. Fixed structure, you can turn off the dividend, have it go on forever as an non-redeemable zero pay instrument if things get tough. Like it's that everything's got to be perfect. So buy the preferred because you hopefully will get refinanced or you'll get your coupon. But if everything's perfect, then buy the equity.
Right.
But don't buy the equity because I want income. Okay, well, then buy the bond. Well, I want more than 200 basis points more. Like it's an awful part of the capital structure for the majority of the people.
Mm-hmm.
And in addition, anything that, pays in PIK or things like that are not desirable. It's a part of the capital structure that is most arbitraged and used by lesser credits. Let's say that. So red flags go up by any risk manager looking at preferred.
Mm-hmm.
And I should say never buy it. I think he's nailed it. And given what I think about the Bitcoin network, about its persistence, its the fact that it's the only one that's been released to the wild of any digital asset. All the others were captured in pre-mines. Given that, I'm going to throw this out there, Tyler, as another, besides Kevin Warsh bending to the knee of the debt gods, I think the mining universe will become even more decentralized. Not I think, it is. And as that happens, that decentralization, it becomes like an even stronger filament, like a van der Waals force, or that surface tension, where it's so widely distributed on a mining standpoint, and let alone a node, that it becomes even stronger. And that preferred will trade to like 4.5% because it relies on the world's strongest network, the most secure, that became even more secure because not only is it distributed, but now it's mining, its workers, its protection is distributed even more so. So that part, I think, is not discussed much. That's the next leg. People don't even understand Bitcoin to start with. But to say that the mining now becomes decentralized, it will, as centralized data centers get more and more attention in dollars, because who doesn't want a 10-year cash flow from a hyperscaler? So they're all going to convert all the Bitcoin ASICs and, are going to switch to GPUs for, as my friend Lisa Huff and her partner Dan Morrison have so clearly stated in their theses out there, and accurately, that as this happens, it's not negative for the Bitcoin network, it's constructive. And it's counterintuitive. But as that happens, I think his preferred gets even stronger. So to hopefully answer your question, is Wall Street, by their, well, not history, but by the book, anyone in Wall Street should say this is a sham because of past work. You have to understand the Bitcoin network to say, oh, now I get it. It's like having a preferred based on a West Texas oil field, or even another asset that could be of increasing, not depleting wealth or origin. So that's it. It's just, it doesn't fit anything, but people will stop with preferred on a asset whose whose underlying price has a 38 volatility. That's odd. I don't know about that.
Yeah.
So again, plenty of time to buy the preferred, folks. Get in there.
Right. You've got me bullish saying it's going to trade at 4.5%. I mean, that how much capital is going to walk through the door to Michael Saylor to buy Bitcoin if if it cranks down that far?
Again, anyone who's so early, you can criticize. And he's a strident personality, strident presentation. He turns a lot of people on Wall Street off because no one wants to think they're missing out on anything. But I think he's done the work and sound, and yeah, anyone should consider it
Yeah.
for sure.
How do you think that's going to play out, Mark? Do you think the addressable market for preferred equities is going to structurally change, once people
It did.
realize?
He's got the largest preferred in the planet. How about that?
Yeah.
How about that? The largest preferred on the planet.
Yeah.
That's not like saying he made 1,000% on a $1 trillion asset that's just a little mite on the total investable marketplace. He has the largest preferred structure of any. Name a company, nothing.
Mm-hmm.
Wow.
Pretty wild to see. Yeah. It'll be interesting to see, because he's been so successful, there are other digital credit products out there, Strive. Strive has one out there that's a lot smaller, in size, but they're certainly trying to compete with that. Do you see, is there going to be a global race, do you think, towards this digital credit model or this preferred style of model that pays a fixed
Absolutely.
income?
Wall Street innovates, and they love credit. They love credit because credit's opaque. Because credit gives them a reason to live. Like we all know Bitcoin, it's not exactly what's it? Hodl and go away. There's people, we should spend it. We should do more with it to help adoption. But yeah, the reason Bitcoin companies, aren't on the aside from sailors in the S&P 500 is because you don't need to do a lot with Bitcoin. It does it.
Mhm.
So if Wall Street's like, oh, I can take something that doesn't need me and then make it need me, I like that. Let me make digital credit where I can build on top of it. So yes,
Yeah.
they're coming.
Yeah, I
Absolutely.
think private credit too is like just an obvious pool of capital that's going to rotate into this partially, because
And what do you mean by that, Tyler?
you've got
How does that?
where you've got basically a liquid instrument with a price with little volatility compared to private credit that banks might offer. That just there's no
Got it. Yep.
transparency into what's backing that. I think it's just a super the demand's insatiable for it.
So you're saying that the banks, the private debt folks, you said private equity, correct?
Yes. No,
Yeah,
no.
so the
private credit, private debt.
Yeah. So the private credit people will say, forget what I sold you in that BDC last week. Don't look over there. I got something better.
Yeah. Yeah, I really
Awesome.
think that's coming. It's going to be fun to watch. I've got the popcorn, and Bitcoin never follows the path we expect. There's always twists and turns, and I'm excited to see how that plays out. And you can't if you've got the stomach for the volatility, you can just sit and stash your Bitcoin and watch it unfold. Do you think digital credit? Do you think more adoption of Bitcoin by potentially governments? We've seen some smaller countries acquire some Bitcoin. We've seen the US say that, hey, we're not going to at least sell the Bitcoin we have. And I think it's inevitable. The game theory is going to play out that sovereigns do adopt some Bitcoin reserves. But is there any way, tying back the first part of our conversation, that Bitcoin or digital capital can give a soft landing to fiat, or are we just destined to have kind of a hard landing and
I don't
Bitcoin
think it's going to
will
be
rise?
Bitcoin alone.
Yeah.
I think the AI animal, and we talked about it. I told you my co-host Bill Mann and I talk about AI as much or more because it allows these folks who have been young people who have been not left behind, but companies aren't hiring to create their own businesses. It's such a creator economy now. Look at you guys, what you've done, and I think the disinflation from the AI build coupled with Bitcoin. So it's not going to be, step on Bitcoin like my image I had 5 years ago. But that is one leg of the trade. Then it's adopting AI so that you can stop your subscription to WordPress or to GoDaddy like I did because I built it myself with CSS and with Claude. So I'm using I think it's $100 a month Max Plus subscription to just eviscerate all the other stuff I'm subscribed to. So that, having Bitcoin, and then maybe using Bitcoin credit somehow, owning it to get income while you build, and you sort of sacrifice some of that principal by having engaging in a Wall Street generated, and they have them already. Morgan Stanley, I believe, already has an option-based defined, wouldn't have corporate credit. I forgot what they call it, but they have an animal that, you have 20% of the upside, 50% of the upside, 10% of the downside, structured credit.
Yeah.
So those are already out there. So yes, Bitcoin plays a part, but you got to get smart on the AI stuff too, no doubt.
Totally. That's another thing. It's like AI has drastically changed my workflow, and I outsource. It's like having multiple assistants working for me, and my productivity is just through the roof compared to what it was.
It
just
is,
a
but
few
have
years
you
ago.
gotten surprised and like bitten by like, oh, sorry, I just read your .env files, so therefore everybody in Anthropic has them. True, that happened yesterday.
Sure.
Like, but I told you can't, and yeah, but I did. So
Yeah.
now I've got to set up an intermediary.
I know. It's privacy is certainly one of the tools that is going to need to be guarded against, and I'm pretty bullish that solutions will exist and pop
Yes,
up.
it will.
And
No. There's ever see the evolution of the automobile documentaries? They're like, people were like, why are we taking knobs out of people's heads in the hospital? So they learned that maybe they shouldn't have knobs on dashboards.
Yes.
So over time, we're going to learn to take the knobs off of AI, so we stop pulling out of people's foreheads.
Great stuff. Thank you so much for spending the time with us today, Mark. Can you tell our audience more about where they can find you and your work?
Sure. My firm is Risk Dimensions. It's at riskdimensions.io is my main website. We're putting more and more of our work up there. We're, freemium some of it. I have a Substack, The Macro Case for Bitcoin. And our podcast is the New Barbarians podcast. Bill Mann and I, all things disruptors, new businesses, and practical ways to use AI, and why Bitcoin folds in so well against that just asset eater that is AI.
Awesome, great stuff, and we'll put that all on the screen and in the show notes for you, Mark. And one thing I have all our guests say before they leave is stay orange.
Stay orange, folks.
Ladies and gentlemen, Mark Connors.
Thanks, Tyler.
Thank you.